Good morning, guys. It's John here with Option Lab. In this video, I'm going to be talking about how I made roughly $2,000 in 1 week with very small account friendly wheel plays. I'm going to explain what the wheel strategy is, how I find plays that fit that strategy, as well as break down step by step how I found these two trades, what the premium was for each, my rationale, and break it down easy for you guys. This will be a short one. I promise if you stay till the end, you will leave feeling very confident with this strategy. Okay, so if you guys are not familiar with who I am, my name is John. I'm the owner of Option Lab. I did roughly $2 million in 2024 trading option premium selling strategies. If you guys want to see my account, I can refresh it right here so I don't get any stupid comments saying, oh, you trade a fake account, blah, blah, blah. Okay, so here's my account. You can see here 2024. So let's actually start breaking down this trade. By the way, if you do want to learn more about these strategies that I'm about to explain, click the link in the description. Join my free Discord Option Lab. The first 10 people to send me the word print in my DMs, I'm sending a 1-day free trial to see my trades, as well as my option selling cheat sheet that explains the strategies I'm about to outline. Okay, so let's go over kind of like how these trades played out and the general strategy itself. So the first thing that we need to understand is, what is the wheel strategy? And I'm going to very simply draw it out here so you guys have an understanding. So the first thing, this is good enough. Okay, so we have a stock, and generally speaking, what I'm looking for is I'm looking for a stock that has made a precipitous drop in a short amount of time that I can get on a discount, right? So I want to buy the stock at a low price on longer time frames. But instead of buying the stock, what I'm doing is I'm writing what's called a cash secured put. So when you write a cash secured put, that means you're selling to open a put. And for doing so, you're collecting a premium. And the criteria for keeping that premium and not being assigned any shares is that the stock stays above your strike price by expiration. So say this stock is at 100 and I sold, let's say, the 90 put. As long as by expiration the stock is above 90, which is my strike price, I keep my premium and I'm not assigned shares. If it goes below 90, my strike price by expiration, I get assigned the shares, but I still keep the premium. And the general strategy, the general idea behind the wheel strategy is, if I am assigned shares at the strike price, I can then write covered calls to get out of those shares. Since I now was assigned shares, I can now write covered calls. Okay. So now that we understand that, let's actually go into the steps of how I executed this trade. So step one is I ran my Bloomberg scanner for low delta, high premium option contracts. So let's unpack that. First off, I've optimized my scanners. They're all in my Discord, by the way, if you want to join. I've optimized my scanners to search for option contracts that have low delta, meaning, so each, let's actually show this on the chart. So this strike price, right, has an associated delta. And if we take 1 minus that delta, we get a probability that the stock will stay above that price by expiration. So in this case, the lower delta, so low delta equals higher probability that the stock does not go below that price. So low delta, high probability that I'm not assigned shares. Great. So the next part is high premium. I want premium that, I want the ratio of the stock price to the premium to be high, right? Because I want to make it worth my while. And I'll show you guys kind of like as when I go through these examples what I mean by that. So step two is selling to open a cash secured put. And I'm typically selling strike prices that are under a 30 delta, meaning it's a roughly 70% plus chance that the stock stays above that strike price by expiration. Step three, I collect the premium for selling to open those puts. And lastly, if I'm assigned, I can then write covered calls since I now own the shares. Okay, so what does this look like in practice? So the first, I'm going to go through two trades here, By the way, both of these are very small account friendly, as I mentioned in the title. So typically I am trading more expensive stocks since I have a larger account, but these are two that are very helpful for you guys with smaller accounts. Okay, so the first trade was this, and I took a screenshot here from my Schwab account. I sold to open the AA 417.25 22.5 put. Okay, so I sold to open 18 contracts. I was trying to get 20, but I only filled 18. And for doing so, I made about $888. As you can see, this fits my criteria of a stock that has taken a precipitous drop in a short amount of time. Therefore, volatility is higher. Higher volatility means higher option premium. And then I can sell puts at a strike price that I'm willing to own the stock at. In this case, I chose the 22.5. The stock was trading, I believe, around 25 at the time. And you can see here that was another order I had in for more. So for doing so, I collected $888. And as long as by expiration AA stays above 22.5, I keep my premium, get assigned no stock. And in this case, I'm actually willing to own AA, which is Alcoa, at 22.5, since on longer time frames, this is a 3-year chart, I'm actually getting the stock at a very steep discount. So it's a sort of win-win situation. And as you can see here, if we look at the option chain, this is April 17, you can see here that the delta that I chose that corresponds with this 22.5 strike price is a 0.18 delta, or a 72% probability that by expiration, AA stays above my 22.5 strike. So that's very good probability. And per contract, you only need roughly $2,000 or a little over $2,000 if you were to be assigned stock. So not bad. Let's go over to the next one, which was United Airlines, or UAL. And you can see here I did the 417.59 puts, and I did 10 contracts and collected $1,293. And again, you can see my criteria. On the 3-year chart, we see a steep drop, and I'm anticipating on this some kind of bounce. There's earnings coming up as well, so volatility was even higher, therefore option premium was higher. So you can see here on a 3-year time frame, it's starting to become pretty oversold. So I went into the option chain here, and as you can see here, I chose a delta with a 0.09 delta strike price. That is equating to the 59, right? So you take 1 minus that, that's a 91% probability that by expiration, UAL stays above my 59 strike price. So I keep that premium, and there's a 91% chance that I don't get assigned stock. And even if I do, I now own it at a discount. I can then write covered calls on it in addition to holding the stock. So it's a win-win overall. If you guys did find this video helpful, please click the link in the description, hop in my Discord. I'm posting trades like this all the time. Both of these were alerted live in my Discord in real time. I message each one of you guys who joins personally, so I hope I can get to know some of you guys better. Anyway, I will see you guys in the next one. Peace.